Let me tell you something most people do not want to hear. The next big market reset may not begin with a recession headline, a banking collapse, or a war. It may begin with a rule change that sounds so boring most people scroll right past it. That is usually how the dangerous ones arrive. They do not come in with fireworks. They come in through the plumbing. And if you do not understand the plumbing, you can own perfectly good assets and still get crushed because you never saw the flow change underneath them. That is what I want to talk about today. A lot of investors still think the stock market is driven mainly by earnings, interest rates, and sentiment. Those things matter, of course they matter. But there is another force that matters just as much at certain moments. Market structure, rules. Who is allowed to do what? Who is allowed to trade on margin? Who gets access to leverage? Who can hit the button more often? Who gets pulled into the casino? And who gets paid no matter who wins or loses? What changed here is simple on the surface. For years, pattern day trading came with a hard line. If you wanted to be a frequent day trader in a margin account, you generally had to maintain $25,000. That line was not perfect, but it acted like a gate. It kept a lot of small, emotional, undercapitalized traders from jumping in and out of the market all day long. Now that gate is being pulled back, and whenever you remove a gate in markets, you do not create freedom first. You create flow, you create volume, you create volatility. You create more people reacting to price instead of value. And when that happens, the first thing I do is not ask which stock will go up tomorrow. I ask a harder question: who benefits from more motion, even if the people creating that motion lose money? Because in markets, the people selling picks and shovels usually do better than the people running into the mine. That is the frame I want you to keep in your head as we go through this. This is not really a story about day trading. It is a story about what happens when the market quietly invites more speculation at the exact moment. A lot of people are already chasing speed, novelty, AI narratives, crypto correlations, options leverage, and meme stock adrenaline. That combination can produce a lot of excitement. It can also produce a lot of broken portfolios. I have watched this pattern in different forms for decades. The names change. The technology changes. The app colors get prettier. The language gets friendlier. But the behavior underneath does not change very much. People convince themselves that faster action means more opportunity. Most of the time, faster action just means faster mistakes. The change centers on pattern day trading restrictions and the old $25,000 threshold that sat between casual retail activity and truly frequent intraday speculation. Under the older framework, a lot of smaller traders could dabble, but they could not really turn a small margin account into an all-day trading machine without crossing that capital line. Now the structure moves away from that simple barrier and leans more on intraday risk models, broker controls, and margin algorithms. That sounds modern, that sounds efficient, that sounds smart. But whenever a simple hard break is replaced by a flexible internal model, you need to ask who that flexibility really serves. It usually serves the institution first, not the customer. The customer hears freedom. The institution hears throughput. The customer hears access. The institution hears more transactions. The customer hears opportunity. The institution hears more order flow, more data, more margin usage, more options activity, more engagement, more ways to monetize behavior. That does not automatically make the change evil. It does mean you should stop romanticizing it, because the market does not hand out more access, because it suddenly loves the little guy. The market opens more doors when someone on the other side expects to collect more tolls. That is the first thing to understand. The second is this. When you lower the barrier for frequent speculative activity, you do not spread volatility evenly across the whole market. You concentrate it first in the places that are already easiest to gamify. That means the names with stories instead of earnings, the names with event-driven price explosions, the names where an FDA decision, an AI headline, a crypto move, a short squeeze rumor, or a viral post can turn an ordinary afternoon into a stampede. Biotech, pre-profit tech, AI. Adjacent names. Semiconductor, momentum trades, electric vehicle, narratives, crypto, linked equities, meme stocks, high beta options magnets, anything that moves fast enough to trigger greed in the morning and regret by lunch. Those are the first pressure points. And once you understand that, you stop treating this as a niche rule for a tiny trading community. It becomes a broad market question. What happens when a new wave of undercapitalized, high-frequency, emotion-led money is allowed to hit exactly the parts of the market that already trade like pinball machines? You get more fake breakouts. You get more violent reversals. You get more short squeezes that die faster. You get more retail investors buying strength late and puking weakness early. You get more price action untethered from business reality. And then, because markets are connected, you get spillover. That is the part many people miss. They think the damage or the opportunity stays inside the crazy names. It does not. Once enough flow starts sloshing around in the speculative corners, it leaks outward through options market sentiment, collateral behavior, sector ETFs, social media narratives, and the psychological tone of the entire tape. A market does not need every stock to be gamified to start feeling more dangerous. It only needs enough visible names to start training investors to think the market is a slot machine again. That is when discipline disappears. That is when valuation starts to feel old-fashioned. That is when good companies get ignored until they become fun. That is when bad companies get celebrated for surviving another week. And that is usually when the smartest people in the room become very careful with position sizing. Now let me be even more direct. The people I worry about are not the professionals. The professionals know what they are doing, or at least they know the risks they are choosing. The people I worry about are the ones who hear this change and think it means the market has become more democratic. That word has done a lot of damage in finance. Democratized access is not the same thing as democratized outcomes. Making it easier to participate in a dangerous activity does not make that activity safer. It just creates more participants. And if the statistics do not change, all you have really done is widen the funnel. That matters because the ugly statistic never really changes. Most habitual day traders lose. Not a few. Most by a lot. The exact percentages move around depending on the study, the period, and the definition. But the core lesson is stable enough to trust. Frequent short-term trading is one of the easiest ways to transfer money from impatient individuals to intermediaries, market makers, platforms, and more disciplined counterparties. People imagine that their enemy is the market. Usually their enemy is their own need to act. So when I see a rule change like this, I do not get excited because more people can click faster. I get interested in where the toll booths are. That is where the real money often sits. Let me walk through the first obvious beneficiary, Robinhood. That should surprise nobody. Robinhood helped build the modern retail speculation interface. It turned friction into smoothness. It turned complexity into bright buttons. It turned parts of finance into a consumer app experience. That was brilliant business. And if you are running a business built on activity, then any rule change that encourages more activity matters. More day trades, more options churn, more intraday engagement, more users feeling like they are doing something, more chances for spread capture, payment for order flow economics, subscription upgrades, margin usage, and all the tiny monetization pipes most customers never think about while they are trying to catch the next move. That is the part I want you to understand deeply. Brokerage firms do not need you to win. They need you to transact. That is why these changes matter so much more to them than to you. If a trader makes a quick 3% on a morning dip, the trader feels clever. If thousands of traders do that all week, the platform feels richer. And the platform usually is. That is the asymmetry. The trader experiences hope and disappointment. The broker experiences throughput. Robinhood sits right in the center of that. It has the brand, the retail mindshare, the behavioral design language, and the historical association with this entire culture. So yes, if more day trading behavior floods in, names like Robinhood naturally sit near the front of the line. But it is not the only one. Webull matters for a different reason. Webull has always leaned a little harder into the active trader identity. It has more of that social, chart-heavy community, fed feel that appeals to people who want to think of themselves not just as investors, but as operators. That distinction matters when a platform has already positioned itself as a place for more active behavior. A rule change like this can move from theory to adoption faster. That first mover edge is not trivial. When a new behavior becomes legally or practically easier, the platform that is already prepared to host it often captures attention before the slower incumbents retool. And attention, in finance, turns into deposits, activity, and eventually revenue. So Robinhood may be the cultural symbol. Webull may be the more immediate behavior funnel. Then you have interactive brokers. This is where the story gets a little more interesting. Interactive brokers was not built to charm beginners. It was built for people who wanted tools. Its DNA is closer to the serious active trader than the gamified newcomer. That means if more small traders start to graduate from entertainment trading toward more aggressive or more technically involved day trading, a platform like Interactive Brokers becomes a natural destination. Not because it is easier, because it is deeper. That is a subtle but important shift. Whenever a speculative wave matures, part of the crowd stays at the shallow end, and part of it convinces itself it is becoming professional. That second group often migrates toward platforms with more data, more charting, more order types, more execution tools, more seriousness. Interactive Brokers benefits from that migration. Charles Schwab enters the picture for a different reason. Again, Schwab is not a pure speculation story. It is a diversified financial supermarket with serious infrastructure and a broader business base. That means it may not get the same emotional premium from this change as a pure retail trading identity play. But it also means it may absorb the change in a steadier, more durable way. Its ecosystem can monetize deposits. Its active trader tools are not an afterthought. Its platform history includes real engagement with traders who want more than a phone interface. And most important, it can benefit from more activity without needing the entire story to rest on a single theme that makes it less explosive. It also makes it more resilient. And finally, there is CBOE. This is where a lot of people looking at the story at surface level miss the best business model. CBOE is not the sexy front-end app. It is closer to the toll road. When you get more speculation, you usually get more derivatives activity. When you get more derivatives activity, you get more volume through the market infrastructure that sits behind all the noise. That is why I always tell people this. When a craze starts, do not only look at the thing being traded, look at the exchange, look at the platform, look at the clearing path, look at the mechanism that gets paid because the game exists at all. That is often a cleaner way to express a view than trying to guess which hot stock a million emotional traders will pile into next Thursday. Now, step back for a moment. If you take Robinhood, Webull, Interactive Brokers, Schwab, and CBO together, a pattern emerges. The clearest beneficiaries of this rule change are not necessarily the people who use the new freedom. They are the institutions that process, host, route, optimize, and monetize the behavior created by that freedom. That should tell you something very important about how markets work. A lot of the biggest fortunes in finance are not made by predicting the next candle. They are made by owning the highway. This is also why I want to say something blunt to anyone tempted to hear this story as permission to day trade harder. You are probably focusing on the wrong side of the equation. The market reset here is not only about what you can now do, it is about what the system can now do with you. And once you see that, you become much more careful about mistaking access for edge. Now let me talk about the broader market implications, because this is where the story gets bigger than 5 stocks. Every time a rule change encourages more short-term participation, market culture shifts a little. The tone changes, the feedback loops shorten, patience becomes less socially rewarded. Watching starts to feel lazy. Activity starts to feel intelligent. That is dangerous. Because one of the oldest and most expensive lies in finance is this one. Doing more must be better. It usually is not. The market pays for discipline far more reliably than it pays for movement. And yet each generation has to relearn that lesson because the interface changes and makes the old mistake feel fresh. In one era, it is chat rooms. In another, it is zero commission apps. In another, it is options on phones. In another, it is crypto. Now it is a new mix of AI options, meme, stock reflexes, and a structural loosening of the guardrails around frequent intraday speculation. The ingredients change, the outcome usually rhymes. A lot of people will confuse volatility for opportunity. A smaller number will understand volatility as a tax on weak positioning. That is the difference. If you are undercapitalized, emotional, impatient, and convinced you need action, volatility will probably take money from you. If you are patient, liquid, selective, and aware of where the toll booths are, volatility can offer you pricing, entry points, and clearer structural beneficiaries. Those are not the same experience. And that is why the same market event can make one person feel energized and another person feel trapped. So what should you actually do with all of this? First, stop pretending this rule only matters if you day trade. If you own broad index funds, retirement accounts, growth names, or high beta sectors, this matters because it can alter the behavior of the market around the assets you already own. Second, tighten your categories. Separate your investing account from your entertainment account. If you are going to speculate, label it as speculation. Do not call it long-term investing at 9 in the morning and then check it every 6 minutes until lunch. Language matters because it controls behavior. Third, if you want exposure to this theme, think structurally before you think emotionally. The brokerage platforms, the market infrastructure, the exchanges, the toll booths. That is one lane. The gamified sectors themselves are another lane, but they are far more dangerous because the same force that can launch them can reverse them with no warning. Fourth, do not confuse a regulatory loosening with a durable wealth strategy. I know that sounds obvious, but people forget it every single cycle. A new door opening in markets often creates a temporary rush of stories, not a permanent edge for the crowd running through it. And fifth, remember who wins when motion increases. Not necessarily the trader, often the system around the trader. That is the entire point. Now I want to pull this together into one clean judgment. This may turn out to be one of the most important market structure shifts in years, not because it changes valuation, but because it changes behavior. And behavior, in the short and medium term, can move more money than valuation does. It can create false leadership. It can create misleading breakouts. It can distort sector performance. It can temporarily reward the loudest assets and punish the steadiest ones. And if you have not lived through enough cycles, you can start to think that the new distorted environment is the normal one. That is when people get hurt. The people who survive these resets are not usually the ones with the best prediction. They are the ones with the best framework. They understand what changed. They understand where it flows. They understand who gets paid first. And they do not let a structural shift trick them into becoming someone they never needed to be. So if I were rebuilding a portfolio around this world, I would keep my core calm. I would keep broad, productive, long-term assets at the center. I would treat speculative sectors as exactly what they are. I would look carefully at the businesses selling the picks and shovels into the next wave of active trading. And I would never, ever let a rule designed to increase market participation convince me that the market has suddenly become easier. It has not become easier. It has become busier. Those are not the same thing. And busy markets are often the ones where the patient investor has the biggest advantage because everyone else is volunteering to become noise. That is how I would look at this. Not as a small technical adjustment, not as a trader's footnote, as a live market reset. A change in who can come in, how often they can press, where volatility is likely to cluster, and which businesses are positioned to collect the economic rent from all that new movement. If you understand that, you do not need to panic. You do not need to gamble. You do not need to chase. You just need to stop looking at the market like a screen full of prices and start looking at it like a system. Because whenever a system changes, the people who understand the change early do not always get rich overnight, but they almost always avoid the dumbest losses. And in markets, avoiding the dumbest losses is one of the fastest ways to pull ahead. That is the real lesson here. Not trade more. Think deeper. Not chase motion. Own structure. Not get hypnotized by access. Understand incentive. That is how you survive the biggest resets. And that is how you put yourself on the right side of them.